Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week, what a show. 3 salient articles for us to dive into. We're going to look at a CNBC article about active managers struggling. Yes, I recognize this is one of my hobbies, to look at active managers and their struggles, but I found this particularly interesting. Next, this might be one of the best articles the Wall Street Journal has put out in terms of its practicality for you, the investor. Financial bubbles happen less than you think. I learned a lot and was pushed on this article. I'm a more confident investor after reading it. I hope you enjoy it. And then, you guessed it, we're going to talk about Pokemon cards, because this is a topic we have not discussed in the years we've been doing this. For all my Pokemon fans out there, you're going to want to bring everybody into the living room on this one. We're going to talk about the incredible increase in price in Pokemon cards and what we can learn from it. At the top, CNBC headlined, this is by Mr. Greg Irikurki. Active managers struggled mightily to beat index funds amid volatility from elections, tariffs, Morningstar finds. By way of review, an active manager is someone who is buying and selling stocks in the hope that they can earn a greater return than the index would be, the index being the S&P 500 or any number of indexes that are just low-cost, simple, passive investing. Active has a human behind it who's looking for cheap stocks and hoping they become more. His subheadline, the ability to outperform during volatile periods is an oft-touted benefit of actively managed mutual funds and ETFs. Oh boy, howdy, I hear that all the time. Listen to this. Just 33% of these active funds beat their index counterpart from July of 24 to June of 25. This was a period, the article explains, when there was elections, executive orders, tariffs, geopolitical risks, a lot of volatility. I have heard with regularity, oh, those index funds of yours, Robert. It's plenty fine when the seas are calm, but you need a captain at the helm for when the storms come. And I will say there's a great deal of advertising for financial products that rest on this very principle. Oh, sure. You're going to invest. You're going to invest when it's calm and easy. But let me tell you, when things get difficult, you need someone with their finger on the trigger to buy and sell to help you navigate these waters. And moreover, it's not just that we hear this in the television or the radio. If you used to listen to that, I hear it in person. If there are pitches today that I hear for the reason why you need a financial advisor that can buy and sell and take into different asset classes at the right time, rotate you into different stocks at the right time, it's because of volatility. Well, would you look at this, an article that we just couldn't have teed up better, where it didn't work. It didn't work. The article explains it's an oft-touted selling point that active managers can actually have an ability to make key trades in volatile periods that beat investors who passively ride the market's ups and downs. Again, that's what I do. That's hopefully what you do. However, data has generally disproven this thesis. Check this out. Elections, executive orders, tariffs, geopolitical risks. It was a roller coaster ride. Conventional wisdom says active managers should better manage those complexities. Performance says otherwise. And the trend holds for the long term. 21% of active strategies survived and beat their index counterparts over 10 years through June 2025. That's actually pretty high. It's not always that high. So, this is where it gets large cap funds, ones that track the S&P 500, the index almost always wins. Only 14% of the actively managed U.S. large cap funds have beaten the S&P 500 over the past 10 years. The article continues. In addition to having low success rates, large cap active funds can also carry steep penalties for picking a loser. So when they underperform the benchmark, they underperform it big. So if you forgot to pick NVIDIA and you're an active manager, you're hosed. Not going to go well for you. Of course, the moniker about keeping your costs low Index funds have on average, a 0.11% annual fee, while active funds carry a 0.59% active fee. By the way, that active fund fee has gone down a bunch. So the index fund has forced, at the end of a gun, basically, these active managers to lower their prices. That's all to the good. That's all to good. So these higher fees, the article explains, eat into earnings. Of course, you're a listener. You know that's no good. Here's what they did. This is where they erred. Many active managers, the article explains, took risk off the table in April when President Donald Trump first announced his so-called reciprocal tariffs. But then the market rebounded quickly. If you were in a fuddy-duddy index fund, you rebounded with it. If you had a genius at the helm with their finger at the trigger, you didn't get back in time, you almost certainly lagged. See, team, that's one of the great benefits of the index. The market timing game is done, which is an excellent segue for market timing dangers in our next article. But let's just do a quick review. The area where active managers have told me historically, oh, Robert, you wait for volatility. Turns out the data says you're better off in an index during volatility. So if someone asks you and you wanted to be coy, I'd be careful being too coy. You don't want to be arrogant. But if they asked you, hey, why do you use index funds? You just tell them they outperform in volatility. Now, you don't always have to say they also outperform in every other environment. But usually that'll start a conversation with someone and say, ooh, how do they do that? Well, they're always fully invested. They're always low cost. And they ensure that every stock is selected. You don't miss an NVIDIA. That's why they work in every season. But they certainly work in volatility because you don't have Larry with his finger at the computer clicking buy and sell. And if he had a bad indigestion or they got a sandwich wrong at Potbelly that day, he's not going to sell the position. Keep indexing, guys. The excuses will keep coming, but keep indexing. And now, for one of what I'll call the best articles I've read in Wall Street Journal. Headline, financial bubbles happen less often than you think. And they happen less often than I think. Your podcast host, who you would hope would know this, did not. I actually thought there were more market crashes than the data shows, but listen to this. Subheadline, bubbles and market crashes make for great horror stories, but research shows how rare they are, that the consequences aren't all that bad. Boy, howdy. So they go back and looked at financial bubbles since 1790. 1790. Whew. We find that this article finds they're much rarer than the presence in the public imagination, and they're rarer than in my imagination. So this research, and William Goatsman is the article, in my research, he says in more than a century of global stock market returns, he looked at how often bubbles occur. Listen to the definition of a bubble. I think this is important for us to not be scared of the boogeyman, the bubble. He says this. He defines bubbles as a rapid doubling of stock prices, followed by a crash that gave back all or more of the gains over the next 1 year or the next 5 years. Looking at all of those possible 5-year periods, bubbles happened in less than 0.5% of them. So that's 100 years, and bubbles happen in less than 0.5% of them. Now, you might quibble with his definition of bubbles. I think it's a fair one, because I think we can call something a bubble on a slight retracement, and it's really not. We were a little too sensitive. A true bubble, he's saying, it's a rapid doubling of stock prices, because that's what a bubble is. Oh, mania, here we go. Everybody's buying in, followed by a crash that gave back all or more of the gains over the next 1 year, the next 5 years. But he says people don't perceive bubbles happen that infrequently, for sure. And you need to research with Robert Shiller, one of our heroes, and Dassel Kim. They conducted monthly surveys of U.S. investors over the past 25 years asking about potential market crashes. Check this. And this is where I related completely. Typically, they put the odds of a catastrophic crash in the next 6 months at 10 to 20%. That's much greater than 0.5%. I'll say that again. Typically, these investors, you, me, Larry at 7-Eleven, typically they put the odds of a catastrophic crash in the next 6 months at 10 to 20%. Much greater than history suggests. Now, this article explains, well, the financial crash of 0809 happened during the sample period, and it probably terrified some of these people for sure. But the data, team, the hundreds of data. There have been a few seemingly catastrophic days, the article explains, but not as many as you think. Since 1887, there have been just 4 cases where the Dow Jones Industrial Average has dropped by more than 10% in a single day. 2 of those were the big crash of 1929. So in our mind, listener, what this journalist is saying, I agree. We make much of bubbles, and bubbles don't do much to us. So anticipation of this dreaded event is almost certainly worse than the actual event when it occurs. The article explains it beautifully. One of the biggest mistakes an investor can make is to rely on a handful of colorful historical episodes, the way Mark Twain might write. I'm reading about Mark Twain. He did a great job of making a humdrum episode colorful and interesting. Oftentimes he'd stretch the truth to do it. And we ignore the long intervals in between. It's the sequence of quiet gains that stock markets have made over the decades and centuries that have existed. This is another great word. This article just has gold in it. A statistician will tell you that the smaller your sample of data, the less reliable it is for forecasting. Well, duh, but hello, we do that all the time in investing. And particularly when the sample is chosen because it's interesting. That happens all. Oh, what an interesting period 0809 was. Let's dig into the data. Oh, look at the retreat. Well, what are we doing? We're just carving off years that are interesting. What about the bubble in 2000? Wasn't that interesting? That Y2K? What was going on? Again, we're carving off data. More research to help you keep your time horizon long. Research has found that since 1900, a long-term U.S. investor who stuck with a diversified stock portfolio, an index fund, in global markets earned returns of about 9.5% a year, despite the crash of 1929. Okay, the Great Depression, the single-day loss of more than 20% on the Dow and S&P in 1987, the burst of the dot-com bubble, or COVID. I'll say that again. Since 1900, you've earned 9.5%, including all those calamities. 1929, Great Depression, single-day loss of 20%. Some of my listeners, I know, remember that. Burst of the dot-com bubble. I think all my listeners remember that. The COVID meltdown, certainly all. Despite all that, global, you heard global, for all my international averse investors, although it's perfectly fine if you could do just U.S., but 9.5%, that's an incredible return. We should be tickled for that. So there's an excellent story in here about Louisiana territory and still in French hands, and how this Mississippi company in 1719, shares in the enterprise started soaring. They rose by more than 1,000% in a few months. So again, this is in 1719. This is a bubble. They thought, this is going to be the greatest thing ever. It ultimately, I think it was. America's a pretty great place. But the investors got in, and all across Europe, they rushed in on this thing, and there was a huge crash. People realized 1719, you could get wiped out. The term millionaire was coined during this craze. So, ended in disaster. The stock market became more popular, and it goes on with Black Monday, 1929, goes into 1987. So these sorts of moments, though, listener, they're etched in our brains in a way they shouldn't be. You remember what I just read to you, from 1900 to present, 9.5% a year, including all those calamities. So the lesson to investing is not, let's avoid, boy, how many products have been sold with this moniker. Would you like the upside of the market without the devastating losses? What are they selling you? Some sort of annuity that is garbage, fees galore, or they want you to give them money, or it's a Ponzi scheme. I've seen more money lost at the promise of 8% fixed, or 9% fixed, or 10% fixed, when in reality, you could actually just buy the stock market with volatility. You can't get the fixed part. That's how the fraud occurs. They have to get, the Ponzi scheme works because old investors being paid by your new investors because well, guess what? You can do just fine without fixed. You got to stomach volatility. There's no free lunch. So these bubbles are etched in our brain. That you remember the NASDAQ bubble, March of 2000, the NASDAQ fell 78% from its peak. We think too much of the bubbles, though. So I know why this article was so good. This William Goatsman is the Edwin J. Benecke Professor of Finance and Management Studies at the Yale School of Management, which I believe is a predecessor entity for Texas A&M University. That's how he knows Schiller and the boys and has access to great data. They have great data over there. There you go. I found this article to be wildly helpful. And in my own mind, I overemphasize the dangers of bubbles all the time. Now, I'm all about not, you can take this the wrong way and say, oh, great, I'll just leverage and not worried about a steep drawdown. Let us not forget Warren Buffett's quote, don't risk what you have and what you need to get what you don't have and don't need. Wealth, and the scriptures, wealth gained hastily will dwindle, but he who gathers little by little will prosper. And in closing, headline, the hot investment with a 3,000% return. You want to guess what it is? It's Pokemon cards. I already told you. The franchise trading cards are beating the benchmark S&P 500 and high-flying stocks like Meta. People are diversifying their investments. I think this is an interesting walk down investor psychology lane. This article goes in detail with all these millennials like myself who grew up with Pokemon, and many of them bought at the lows. It's got this hilarious chart in the article showing Pokemon cards, Meta platforms, baseball cards, and the S&P 500. The laggard in those four was the S&P 500. Of course, it doesn't include Beanie Babies and all the other bubbles. I say bubbles. That may have been a bubble that burst. But you look at a chart like this and you kind of go, oh, maybe I need these Pokemon cards. Again, what I find most interesting is this psychology. When you listen to they interview these various purchasers. One of them, Matthew Griffin, I thought had the best self-reflection. He says, a lot of us are chasing pieces of our childhood. You listen to what his investment plan is. He plans to gift the binders to his children, currently aged 9 to 20, when they reach personal milestones, such as getting married or buying a home. So this gentleman is going to hand booklets of Pokemon cards. Many of these, by the way, are worth $100,000 or more. Here's an example. Mr. Logan Paul, famous internet gentleman. He bought one card for $5.3 million, the Pikachu Illustrator. Wow. There are some baseball players who say, oh, they're better than baseball cards. This is funny. Quote, Pikachu's not going to tear his ACL and miss the whole season. Charizard is not going to get a DUI driving home, Philadelphia Phillies pitcher Matt Strahm said in a recent interview. Something to remember here is that if your investment relies on someone else coming along and paying you more for it to gain in value, it's not a position of strength. So for Pokemon cards or anything else that relies upon someone else bidding up the price, it doesn't have cash flows, it doesn't have the hope for future of cash flows, you're on thin ice. Doesn't mean you can't work. Look at the Pokemon cards. Some of these folks have hundreds of thousands of dollars in their garages, in these booklets that they plan on giving to their children. But as for me and my house, we're going to keep our costs low, our investing simple, and our time horizon long, because that is what's going to give us the best shot on our investment journey. Until next week.